All right, let's dive right in. We're going to tackle a classic investor problem today. How do you take the world's most famous stock index, the S&P 500, and turn it into a real, spendable paycheck? We're going to break down a super popular ETF that's designed to do exactly that.
I mean, we all know the S&P 500 is just this incredible engine for long-term growth, right? But if you actually need income to live on, its dividend yield, let's be honest, it's pretty tiny. So you've got this amazing asset, but it's not really helping you pay the bills. So what do you do?
Well, that exact problem is what the NEOS S&P 500 High Income ETF, that's ticker SPYI, was built to solve. It's designed from the ground up to let you stay invested in all those big familiar blue chip stocks, but at the same time generate a nice high monthly income stream.
Okay, so how does it actually do that? How does it manufacture that income? It's not magic, right? It's basically a two-part engine. It combines the stocks you already know with a pretty sophisticated options strategy. Let's pop the hood and see how this thing works.
At its core, it's actually pretty straightforward. First, the fund just owns the stocks in the S&P 500. Simple enough. That gives you your basic market exposure. But then it layers on the second part. It sells call options against the index. That generates a consistent pile of cash, a premium, which then gets paid out to you as your income. Now, the kind of options they use here is absolutely critical. SPYI specifically uses what are called SPX index options, and that choice really matters for two big reasons. One, they're cash settled, which just makes everything clean and simple. But two, and this is the big one, they qualify for some very special tax treatment, and that's where this whole story gets really interesting. Seriously, this potential tax advantage isn't just a small feature. It's the secret sauce of the whole fund. It's what really separates SPYI from a lot of its competitors. And, it can have a huge impact on what you actually get to keep after taxes. For the first key piece of this puzzle is something called return of capital, or ROC. Now listen up, because this is important. This is not free money. What it is a type of distribution that you don't pay income tax on in the year you receive it. Instead, it just lowers your original cost basis. So you're basically kicking the tax can down the road until you eventually sell.
And look, this isn't just some minor feature. For SPY, a massive chunk of its recent distributions, we're talking around 98% according to their own documents, has been classified as this tax-deferred return of capital. That has a huge effect on how much cash an investor in a regular brokerage account actually gets to keep each month.
Okay, so the second part of this tax story comes from the options themselves. The gains from these SPX options get special treatment under something called Section 1256 of the tax code. All you really need to know is that this gives them a favorable 60-40 split. 60% gets taxed at the lower long-term rate, 40% at the short-term rate. The bottom line? It can lead to a much lower overall tax bill on the income the fund kicks out.
But you knew this was coming, right? There is no free lunch in investing. To get that high, potentially tax-deferred monthly income, you gotta give something up. So what are the trade-offs? What's the price you pay for this strategy?
So it all boils down to this central bargain, this trade-off. On one hand, you get that awesome high monthly paycheck and the potential for tax deferral, but what do you give up in return? Well, you're capping your upside. You give away some of the market's biggest gains. Also, those distributions, they're not fixed. They can and will vary. And let's not forget, at the end of the day, you still own stocks, and stocks always come with risk.
And yeah, another part of that trade-off is the cost. The expense ratio is 0.68%. Now let's be real, that's a lot higher than a dirt-cheap S&P 500 index fund. But for what this is, an actively managed fund running a complex options strategy, that fee is pretty much right in line with its direct competitors.
Okay, so with all that in mind, let's get practical. Where does a fund like SPYI really fit in? Understanding how it's supposed to act in different types of markets and how it stacks up against its rivals is the key to figuring out if it's right for you. All right, first scenario, the grinder market. This is SPYI's sweet spot. We're talking about a market that's just flat or maybe gently rising. In that kind of environment, the income it generates from selling options becomes a massive part of your total return. It's in these markets where it can often keep pace with or sometimes even beat the plain old S&P 500.
Okay, next up, the rocket ship scenario. This is where you see that trade-off we talked about in real time. When the market is absolutely ripping, soaring 20% or more in a year, SPYI is almost guaranteed to fall behind. Why? Because by selling those call options, it's already sold away a big chunk of that explosive upside. That is the price you pay for that consistent monthly paycheck.
And finally, what happens in an air pocket, a sharp downturn? Well, the income from the options helps a little bit. It provides a small cushion, but, and I need to be super clear about this is not a hedge. It's still an equity fund. If the S&P 500 drops 15%, you should fully expect SPYI to take a pretty big hit too.
So how does it stack up against the other big names in this space, like JEPI and XYLD? Well, the key difference for SPYI really is that tax angle. JEPI, for example, uses a different bucket of stocks in these complex things called ELNs. XYLD runs a more basic covered call strategy. Neither of them has that same laser focus on taxes that SPYI has, with its special Section 125 options and that high return of capital potential.
Okay, that's enough of the theory. Let's talk about putting this thing to work. How would you actually use a fund like this in a real-world portfolio? Let's go through a few common types of investors where SPYI might make a lot of sense.
So for starters, think about retirees or people in the FIRE movement. For them, it could be a primary paycheck generator. For younger investors who are still saving, that cash flow can be a great source of funds to reinvest into other things. Because of its tax structure, it's a really natural fit for a regular taxable brokerage account. And one more idea? You could use it in a barbell strategy, pairing this income-focused fund on one side with an ultra-low-cost index fund on the other, giving you a mix of both income and pure growth.
So, at the end of the day, it really all comes down to this one single question you have to ask yourself. Is giving up some of the market's absolute best days, that blue sky unlimited upside, is that a fair price to pay for getting a steady, potentially tax-deferred paycheck in your account, month after month after month? Only you can answer that, and it all depends on what your financial goals really are.